Hello and welcome to our 2016 fourth quarter review and M.A.P.S outlook. This is the quarterly chart series that we produce at Econ Wealth Management from the asset management area of our business. I'm Steve M.A.P.S. I will be guiding us through the consistent format that we normally cover in this review. And our theme today, as you notice on this first slide, is discipline and patience. Not always easy, but something that we feel will benefit our investors. So looking at the agenda, cautious is the 2017 theme. We had recently upgraded our, I shouldn't say upgraded, but I should say we've recently changed our outlook from favorable to cautious. We're going to cover a little bit on that today, as well as a little bit deeper into the macro strategy on a short, intermediate, and long-term look. We'll look at the asset strategy and try to relate for you some of the strength we're seeing in things like rates, oil, and then the materials and energy sector, and contrast that with some of the weaker areas. And we're going to talk portfolio strategy like we always do, and what we're thinking here for this year, especially in the areas of bonds for those investors that are more conservative and international investors. So let's start out with our M.A.P.S outlook. And one of the things we'd like to start educating clients about this year is term. In other words, when we are asked the question, what do we think? We try to look back and review our charts, but we try to answer that question by suggesting, are we talking short term? Are we talking intermediate term? Or are we talking long term? And when we produce our M.A.P.S outlook, that is normally the 3 to 6 month period, and that we consider to be intermediate. So let's look quickly back at this chart of the Dow Jones Industrial Average over the past 2 years. And you could see what we have is a potential pattern that we consider to be a double bottom. This provides us with lots of information and gives us the ability to look at a higher target than we are over the longer term. So far, we still have a favorable outlook on the longer term. But when we look here, the short term, this is the trend that we're following, and you can see how steep this line is. That often doesn't continue. So in looking at the short term, we basically have an opinion that it probably needs to do something. If it moves a lot higher from here, even though we're cautious, we'll participate somewhat, but there's a little bit more downside than potentially near-term upside in the short term. In that intermediate term, you can see there's a pretty good distance between this and the intermediate term trend line. Hence, that's why we've turned cautious. If we were to move closer to this line, we might reevaluate that opinion. But when we look at the long term, and this is a look at the last 5 years, our outlook at October was, as you can see, favorable. But currently, we've now concluded at the end of December that we wanted to be cautious for those reasons I just pointed out. The long term is still favorable, as you can see if I were to draw the arrow across here. So when we're asked that question, we truly do believe that although we suggest caution, and that's the intermediate outlook in the next 3 to 6 months, there's definitely short-term unfavorable, but potentially could turn back to favorable if we see a drop or we see it continue on this sideways motion like we have since we've turned cautious. And the one that we're mostly worried about is the long term. So for now, we're okay, but we're highlighting 2017 as our cautious theme. And part of that reason is, as we've been educating a lot of clients, is when you look back, you would have expected some sort of decline once a year of about 10% or more. But once out of every 4 years, you would expect a bigger drop in the area of about 20%. And you notice the last big drop like that was in 2011. So we're overdue for a bear market. that's why we want to keep an eye on that, and we feel that caution is warranted at this point. When we delve down into this asset level, we look at things like the interest rates. As you notice, we've had a very sharp move higher in the 10-year Treasury yield. It peaked here in December at about 2.6, well off of its sub 1.44 level. So what we want to watch here is as interest rates go up, bond values decrease. If you're a conservative investor, you've felt that in the last 6 months. We've addressed that a few times with bond investors, but it's still difficult when you see the stock market rising and the bonds that you hold going down in value. Well, here's why: because interest rates have gone up and they move inversely to prices. We have seen it come back a little bit, so we're going to be keen on this level this year. Interest rates will matter because rates will determine what people do with their money at the bank, if they keep more money at the bank versus investing it. So we think that this level around here, 2.6%, is pretty important. And as a matter of fact, a pretty big bond manager came out in the last few days discussing this actual level, because it's not only important in the short term, but the 30-year trend of rates coming down since the late 80s would be broken if we stay above 2.6. So stay tuned for that. We've been talking about oil for quite a while now. This is only the 1-year chart, but the move off of the bottom when it was in the 20s has actually gone through a nice pattern right here and then moved higher, but has recently moved back in. We're of the mindset, based on our sector rotation process, that we are seeing strength in energy, materials, also industrials, that we think oil is going to be leading us higher, which means potentially higher gas prices this year. And when you look at the materials, this is an ETF that represents the material sector. You could see a similar look where it's moved higher. And the same with energy. And early last year, these were sectors that nobody liked. So they've moved quite a bit higher, which tells us that we are possibly in the late innings of the cycle of the economy. And that also keeps us aware of the fact that a bear market could be right around the corner. If you want to see a contrasting sector, this is an ETF that represents the consumer staples area. And unlike the ones we just looked at, this is heading down. Now, if the market were to turn to the downside, a chart like this might move back higher. But you can note the difference between a chart like this, where we're seeing up movement, and one like this that we're seeing down movement. And these are asset level signals in our process that tells us potentially we're, again, closer to the end of the economic cycle, which often foretells the potential for a bear market, or at least a 10% correction. So our portfolio strategy is what matters most. And with the bond section being important, we're seeing how bonds have come down in value, because we had discussed the yields going up, if you remember the previous look at yields. So if you're holding bonds and you're generating income, you're still getting the income. However, the value has come down. We think that if you own bonds, we want to own them in the correct areas, and you want to be patient. And you have to understand why you own them and not the stock market, while the market might be going higher. We also want to take a look at international investments. There's been a lot of discussion that this year would be another poor year for investors having a diversified portfolio. We've always emphasized diversifying, and having international we feel is important. But this chart is starting to favor an upside move on the international market, so we've remained invested in those in spite of hurting some of the performance in 2016. But we also believe that the global economy is improving in spite of there's going to be a number of big events happening overseas. We still believe international is an important part of an investor portfolio. So to summarize, discipline and patience. And believe it or not, it is a form of action when you're patient. So we've been really exercising that, especially in light of the fact that we see 2017 as a cautious theme. There's going to be an impact with what happens to interest rates and hence bonds and international investments. That's what we just looked at. For our process, we're always looking for value. So our play-by-play, which is published every Monday at our website, will give you updates on what this video summarizes, but also where we're currently looking on a week-to-week basis. The idea is, how do we find things that are on sale, but also look like they can move higher for our investment portfolios? And at the same time, we believe that in 2017, selecting securities will matter more than any of the previous years. There's a big transition in which sectors are performing and which are not. So if that continues to hold, if you notice the sectors we've highlighted, those are areas that we'd be looking at to make investments. Tactical positioning will be important. If you're an income investor and you've held bonds, the big question to discuss is, are you favoring growth for your money or income? And this is an important question within your plan and discussing it with the wealth planning team. Growth investors might be disappointed if they're holding bonds with values coming down. If you're living off of different income, if you're living off of different income situations, then you can get through the volatility that might come along with the volatile rates that we could see this year. How do you protect yourself from the bear? Well, that's why we're cautious right now. We're not suggesting that the market may not, what we call, melt up another 10 to 15%, and we will do our best to participate, but our sensors are more on the caution side, and we believe that that can be prudent to help protect for when the bear does come. Keep updated with our program updates. They're posted quarterly online. We manage for you. We have a number of different investment objectives that we've discussed before. I'm going to go through these fairly quickly for you. The strategies for our programs are listed by growth, income, and preservation. And we have a core, a revenue, a strategic, and a tactical look, including pilot series portfolios that are new for 2017. We held a very successful investment forum in October, and we had a nice holiday open house. We have other events coming up here in February and March. Hopefully we can see you out there, but please visit our website for more information and staying connected. As they're saying now, start the e-conversation with Econ Wealth Management. So what we see is listed out there. It's a lot of the information I just discussed with you. Off of the charts is what you'll find at our website, and we plan to expand that into April of this year, as well as Informed Investor, helping you with the wealth planning topics that matter most. Our market playbook will contain this information as well as our 2017 outlook, which will be sent to our clients along with this video today. The 2017 outlook will give you a little bit more detail on what we've discussed in this video. Hopefully you find it helpful, or at least gives you questions to ask us about your personal investment plan. Stay connected on Facebook, Twitter, and LinkedIn. And of course, we have some important disclosures that are appropriate to not only what we covered today, but for you as an investor. But as always, if you do have any questions on anything that you saw in this video or anything that we've covered with you personally, please feel free to give us a call. Contact our office, whether on the phone or on email. And there's my family at Christmas time. I hope you have a great 2017, and we look forward to seeing you again very soon.